Committing to long-term position trades. This is a manner in which if you sense that the economic environment of a specific region is under a major shift and you think the value of their currency is going to fall or increase in value versus other currencies, then committing to long-term position trades can be a really effective way to place your capital, whether it's through specific investments within those regions or whether you're actually just simply placing funds in that currency on a speculative basis with the sense that over the long term that currency will appreciate in value over the other crosses. When looking at the technicals, you want to plan these trades on a larger time frame, typically daily, weekly charts, or even 4-hour charts for medium to longer term trades. And I find that the daily chart is probably the most user-friendly, or technically user-friendly chart that is in a real strong connection with the current fundamentals that are present within specific regions for short to medium term time frames. If you're looking for an entry or major market shifts from a technical perspective on the daily chart, then you want to move down to your smaller time frames when you decide on an entry. So for example, if we see a breakout of a consolidation or a trend line break or a major shift, once you see the confirmation on a larger time frame, you can go down to the smaller time frame to confirm or to refine your entry to get the best possible entry. You want to adjust your position size, once again taking into consideration risk. Risks should be the number one factor, and you should risk no more than 1 to 1.5% on a long-term trade, which means that typically your stops will be much larger when trading off the larger time frames. And what that means is that should be reflected in your position size, and your position size should be much smaller than an intraday position that you may take with a smaller stop and a larger position size. You really want to commit to your trading parameters once you've defined technically and made a decision on your entry. You want to commit to these parameters, and you have to trust in your tools in these situations and just watch the market. Maybe just check your computer once a day and watch price action. But what's equally important in these long-term trades is really having your pulse, your hand on the pulse of the economics, and to see what's happening in with the region's major manufacturing, the interest rates, the GDP, the short-term economic data, employment, real estate, and so forth. And that's very important, because that, if you have an alignment of both the technical factors and the fundamental factors moving in the same direction, then that is really strong for your trade. If you have them moving in opposite directions, then your trade could be quite volatile or choppy, and could potentially reverse on you as well. While in these long-term position trades, you can expect large equity pullbacks that will definitely test your psyche. It will test your fear and greed tolerance, and potentially cause you to react in a certain way that's not in the best interest of your overall position. Before placing your long-term trade, you have to consider the risk, 1 to 1.5%. Have a clear plan for managing your stop once you get into the position, because there are a multitude of ways that you can manage your stop, as I said, behind key technical levels or behind range levels as well. You also have to resolve within your mind, you have to once again submit to the time that it will take for this trade to come to fruition and play out, and just simply set into your mind that this trade could take 2 weeks, 2 months, or it could last even longer. If you're trading on a off exchange platform, then you have to consider the cost to carry the trade, and there may be a rollover charges on the trade, or you may even collect interest on the currency cross. When you enter into the trade at a future date, you may want to let's say you've entered a long trade. You at some time in the future you may want to enter a separate long trade, but once again you have to take into consideration your overall equity management plan and treat the two trades as separate. As well, you may have a separate account where you may want to take a position, a short-term position against your long-term position, and that's something that I actually do when I'm in long-term positions. I definitely do take retracement trades in the interim. Looking at a few examples here of long-term position trades, we saw the Swiss franc here. We saw a rally, we saw a nice double top, and then we saw a retest of the double top and a nice fall. Price swung back up, and a retest of the retracement level, then an aggressive move down, and the faster this moved down, the more I like it. And then we had a if you observe this on an intraday level, we would see this very distinct bottom formation here, and then price came down 2 days later. This day here is a weekend, but a day and a half, 2 days later, we saw price come down and slip through, but it didn't hold, and look where price closed. So if on a daily chart you see that price has come down like this and failed to make a lower low after such an aggressive move down, and price moves above and doesn't hold below the low. In fact, it closes generously higher, closes up here. Then you start to look for a long-term position trade, but your stop is going to be much bigger, correct? And so here we've got the 200-day moving average, but also the this level of resistance and support doesn't quite get there, unfortunately. Falls about 20 to 30 pips short, and then rallies. Again, the test of these highs right here was a good position trade and would have carried you for about almost 2 weeks. Just drawing this out technically now, we have resistance becomes support, which doesn't really come into effect. This line here is a representative of the divergence. MACD makes a higher low while price has made a lower low. And if we look at price action up here, we see this level of support, a downtrend line. The trend line is broken, tests the backside, and then rallies. You see what I'm talking about here. You will always hear me say how price has to stay and hold and remain above key levels. I talked about that down here. If price were to move below and trade below, then there's no consideration for a reversal, but the test and rejection was a good opportunity for a trade. And here we see that price moves above and actually holds above, and then it actually comes for the retest, and you see after this retest here in a rally, then that was a real good sign that price would continue. This is a British pound daily chart, and I've just spread it out to give you a bit of a view on this one. We've had this long-term uptrend that has occurred over a period of over more than 2 weeks, and then the uptrend is broken. Price comes back up and hits the backside and actually forms a head and shoulders formation here. And if you see, we're in a downtrend. Price comes up, retraces, forms a head and shoulders. It's a good opportunity here now for a position trade. You can trade the right shoulder, which is really in perfect alignment with the left and a real nice setup, or you can trade the break of the neckline. But again, making these kinds of trades, if you're just moving cash or taking what's intended to be a long-term position, you have to build in a large stop. Here we have what we have here is we have with a head and shoulders, but we've got a head and shoulders on the right shoulder, and you can trade. This is a confirmation of the larger head and shoulders, and you can trade this break on the we have a head and shoulders in a head and shoulders, and on this Tom DeMark trend line you can also trade the tweezer retest. And this is a daily chart, so what I'm showing you these patterns on a daily chart for a reason, and that is that although it may take several days for the trade to come to fruition, the daily chart, the technicals the technicals that come out in a daily chart are very expressive of what's happening at a micro level as well. It just takes time for the trades to come to fruition. Looking at a 4-hour chart now, you see here how we established a very significant low at 7,300, the figure, and price had come down. Fairly aggressively, and then it had spiked below the low and was rejected within the same trading session effectively. And this is a real nice rejection because it's very, very aggressive. On a daily chart, this would be a real nice wick that had punched through here, and price rallied after it rallied actually quite significantly after punching through. And you can even, when you take a position trade, it's important still to take profit at an early level because it may still reverse against you. For example, if you had traded this long here, then you didn't take any profit on the way up here. I mean, it moves 200 pips up. This, after this rejection, it moves 200 pips up. If you didn't take something in there, price would have come all the way back and teased your position down here before rallying another 900 pips. You're either in the process of growth or in the process of decay.